You've been told that if you just keep investing consistently, everything will work out. Buy the S&P 500, hold long term, ignore the noise, but here's the uncomfortable truth. In 2026, most Americans are investing wrong, not because they're stupid, not because they're lazy, but because they're following strategies that worked in a different economic era. And the rules have changed. If you don't adjust, you won't just underperform, you'll quietly fall behind. Let's break this down. Mistake 1. Blind index investing without context. For years, passive investing has been the religion of the middle class. Just buy the S&P 500. And yes, historically that worked. But here's what most people don't understand. The S&P 500 today is not the same S&P 500 from 2005. It's heavily concentrated in a handful of mega-cap tech stocks. The top companies now dominate an unprecedented percentage of the index. That means when you think you're diversified, you're not. You're overweight in a small group of companies, driving most of the returns. If they keep winning, great. But if leadership rotates, and it always does, passive investors get exposed. In 2026, concentration risk is real, and most investors don't even know they have it. Mistake 2. Ignoring valuation. Another dangerous trend. People don't care what they pay anymore. They just buy price-to-earnings ratios, forward earnings expectations, margin compression, all ignored. When liquidity was infinite and rates were near zero, valuation didn't matter much. Now, interest rates are structurally higher than the 2010s. Capital is more expensive. Money is no longer free. And in higher rate environments, overpaying destroys long-term returns. If you're buying assets at stretched valuations, expecting 2019-style gains, you're setting yourself up for disappointment. Mistake 3. Chasing performance. Retail investors still do the same thing they've always done. They chase what just went up: AI stocks, crypto rebounds, hot ETFs. By the time most people buy, the asymmetric opportunity is already gone. In 2026, information spreads faster than ever. If you're hearing about an investment everywhere, you're late. Smart investors position before the narrative explodes. Average investors react after it trends. That gap is expensive. Mistake 4. No risk framework. Here's a harsh truth. Most Americans don't have an investment strategy. They have positions they don't know, their risk tolerance, their downside exposure, their liquidity needs, their asset allocation by design. They just accumulate assets randomly. But investing is not about returns first. It's about survival first. If a 20% drawdown would make you panic sell, your allocation is wrong. In volatile macro cycles, risk management matters more than upside. And most portfolios are built for bull markets only. Mistake 5. No cash flow assets. A huge psychological and structural flaw. Over-reliance on appreciation. People assume, if it goes up long-term, I'll be fine. But assets that produce cash flow, dividends, income strategies, businesses create resilience. They allow you to reinvest during downturns. They reduce emotional pressure. They build compounding strength. In uncertain economic cycles, cash flow is oxygen. Appreciation is hope. Hope is not a strategy. Mistake 6. Ignoring macro shifts. The 2010s were defined by low inflation, cheap capital, globalization tailwinds, tech expansion. The mid-2020s are different. Persistent inflation pressure, geopolitical fragmentation, higher structural rates, fiscal imbalances. Asset allocation that worked in one regime does not automatically work in another. You don't have to become a macro economist, but ignoring macro entirely is dangerous. Markets don't operate in a vacuum. So what should smart investors do in 2026? Let's get practical. Instead of blindly following outdated advice, consider this framework. 1. Diversify beyond megacap dominance. Look at equal weight exposure. Look at international diversification. Look at sectors underrepresented in headlines. 2. Pay attention to valuation. You don't need to time the market, but you do need to avoid extreme overpayment. Valuation discipline compounds. 3. Build a core plus satellite strategy. Core diversified long-term holdings, satellite. Selective high-conviction opportunities. This balances stability with upside. 4. Prioritize cash flow. Dividend growers, income ETFs, real assets, or even entrepreneurial income streams. Cash flow reduces dependence on market timing. 5. Define risk before return. Ask yourself, what would make me sell in panic? If you don't know, you're not prepared. The real problem isn't knowledge. Here's the uncomfortable part. Most Americans actually know basic investing principles. The issue is behavior. Impatience, overconfidence, herd mentality, short-term dopamine chasing. The market transfers money from the emotional to the disciplined. And discipline is boring but profitable. Final thought. In 2026, the biggest risk isn't missing the next big stock. It's assuming the old playbook still works unchanged. Markets evolve, cycles shift. Leadership rotates. Strategies that succeed adapt. Strategies that stagnate fade. You don't need to predict the future. You need to build a structure that survives multiple futures. That's how wealth is built quietly, not by chasing hype, not by copying headlines, but by thinking independently when the crowd moves emotionally. And right now, the crowd is more emotional than ever. If you found this valuable, subscribe, because we're not here to follow the crowd. We're